Hey everybody, welcome back to my channel. My name is Ben Wheeler. I am a local realtor in Northwest Wisconsin. Today I am here with Scott Prindle from Loan Depot, and we're going to talk a little bit about a loan program that is an interesting one, and it could come into play if you are an investor or an entrepreneur. You might have money, but lenders don't want to touch you with a 10-foot pole.
My name is Scott Prindle. I work for Loan Depot. I've been doing mortgages for 24 years. MLS 286282. DSCR, debt service coverage ratio loans.
Debt service coverage ratio.
Yep. If you're watching this video, you're probably going to want to share this with your friends because none of them are going to believe you. So it's a program. It's been out there for a while. Just nobody actually utilizes. It's kind of like something that people just heard of, but they don't think it's real. Let's say you're self-employed and you don't say you make any money whatsoever. You write everything off. Yeah, that's a lot of people.
That's what you do.
That's what you do.
Otherwise, you're going to pay the man.
Yeah, the federal government's not watching this video right now.
No.
So you write it all off. But you say, I don't make any money. Well, a normal bank is going to say, I'm sorry, but you don't make any money. You can't go get a normal loan.
Makes sense.
Normal.
Yeah.
A DSCR loan says, we don't need to see your income. What we care about is the property you intend to purchase or the property you own. Okay, we're going to be talking purchases right now. But the property you want to go purchase, does the amount of rent that's going to be coming in the future of this property cover the payment that you're going to be having on this loan?
Okay.
Is it going to cover itself? Is it going to cash flow?
That makes sense. Yeah.
So what they care about is that. They don't care about, could you make $100,000 a year to be able to afford this? No, they don't care. They know you're going to be making money off of this. Therefore, is that money you make going to cover the mortgage payment?
Okay.
Now, you're going to say, well, how do they do that? Okay, so what they do is they actually say, let's go get an appraisal done. That's called the 1004, a normal appraisal. That's going to tell us the value, going to tell us, is the property as is or subject to improvements?
Sure.
Obviously, it has to be as is on this type of program.
Okay.
But also what they order is what's called the 1007, which is a rent schedule. What we're going to tell the appraiser is, hey, is it worth it? But also tell us, what does the rent come in on this property? How much is the rent on this property in this area?
Sure.
Now, there's two ways to do that. Long-term rent, like 12-month lease.
Regular residential
lease. Mm-hmm. Or short-term. How much would this get for Airbnb? How much would this get?
Yeah.
That's going to be a bigger number.
Huge. Totally.
Yep.
It's 4 times.
Yeah, it's going to be a short-term lease. Now, what they care about is, what is that number? What does Airbnb say this is going to be making in this area for this house in relation to the mortgage payment? If it's a 1-to-1 ratio, it works. So if your mortgage payment's $1,500 and the rent schedule says the payment or the rent that's coming in is $1,500, you qualify right then and there.
That's it.
You could have no money coming in whatsoever, no income.
Yeah.
But will this house you buy cash flow the mortgage in which you're trying to purchase?
And that's really all that matters.
That's what matters.
Your appraisal comes out where it's worth it.
Yep.
Or the property value is there. And it's going to cash flow to cover that payment.
And it works. That's what they want.
That is so simple, it seems like.
Yep.
And that's the way kind of it should be, right? I mean,
it really is that simple on rentals. So now, is the rate going to be 1%? No. It's going to be higher than your average. It just depends on each individual thing. Also matters on, is it a 1-to-1 ratio? Is it a 1.2 ratio? Is it a 1.3 ratio? There's different ratios involved. Okay. Don't worry about yourself with that. Just decide, do I really want to get into this game? Do I want to buy this? Now, can you have horrible credit scores? No. You still got to have good credit scores. Okay. Can you do this with no money down? No, you can't do it with no money down.
Still need money down.
You still need 20% or greater down. There are some 15% down ones out there, but they're really hard. So just plan 20% down or more. Okay. But yeah, good scores, good down payment. Will the rent cover the new mortgage payment? You're good to go.
I mean, that makes sense because you want to have good credit and you're going to have to put some money down. But as long as the property cash flows the amount of the mortgage, what the mortgage is going to be, then you kind of just go from there. Yep. You don't need that. You don't need a work history or W-2s or 1099s or
I want a driver's license, a social security card,
5 years or anything like that.
Exactly, and a blood sample.
Firstborn.
No, you need your driver's license, social security card, and 2 months bank statements. And then obviously the appraisal, the title, and the rent schedule.
And you can use that for a long-term rental or a short-term rental.
Yep.
So if you wanted to get into that short-term Airbnb rental, this could be a good way to get into that market.
As long as you've got the funds.
If you get the funds and you get
key.
the credit, of course, then you can get into that market of doing something.
Yeah, and this is on the purchase side. There's even a refi side. You don't make money. You just write it all off. And let's say you say, I want to pull money out of this house. You can actually still do that as well, up to 75% of the value.
So let's say you have a current Airbnb.
Yep.
You have really good equity in it.
Yep.
It's cash flowing just fine. And you want to refi that. This could be an option for that if you're in that situation where you don't necessarily show the income that a traditional bank would want.
Yep.
But you'd be able to provide, you obviously have the house and you have what it rents for.
Yep. And then we'd get the rent schedule. If that's the case, you kind of know where the rents are sitting at that point.
And then you can just use that to pull money out to potentially go on to
the next DSCR.
Yeah.
So you could pull money out, get your 20% down or more, 40%,
right?
And then go buy 2 more DSCRs.
So you can use the equity from your initial Airbnb, let's say in this style loan.
Yep. To buy more.
And that could be your 20% down for the next place.
And you could still be saying on taxes, I make no money.
That's really cool. All right. Well, that's some really good information about a loan program that you could use as an investor to really get around some of the restrictions that a traditional lender or a mortgage company would offer. So what's the best way to get a hold of you, Scott?
They can always email me at sprindle@loandepot.com or just call my cell. I'm available all the time. 414-534-4742.
And again, thank you for watching. Make sure you subscribe, like, and leave a comment. Take care.